In the 1980s, the Hunt brothers tried to corner the silver market, and the system broke them to protect itself. But what if I told you that for the last decade, the most ruthless and systematic suppression in financial history wasn't happening in silver? It was happening in XRP. While retail was shaken out by the noise of lawsuits and FUD, the biggest minds in the space, like Jake Claver, saw the truth. They saw billions of tokens flowing through OTC deals directly into the vaults of central banks and sovereign wealth funds. Today, as we stand in early 2026, the data is no longer a secret. Exchange liquidity has evaporated to 8-year lows. Spot ETFs are hoovering up what's left like a vacuum cleaner. And the supply shock isn't just a theory anymore. It is a programmed inevitability. Tonight, we go beyond the charts. We analyze the perfect storm that Jake Claver analysts have been pounding the table on. From the $4 trillion tokenization wave to the Digital Asset Clarity Act final steps in Washington, the fuse is lit. The question is, are you holding the match or are you watching from the sidelines as the paradigm shifts forever? Welcome back. I am the calm analyst. To understand where we are going, we must first look at where the tokens are disappearing. For years, the retail market has been obsessed with the price on the screen. But while the public was staring at a frustratingly tight range, the smart money was executing a masterclass in accumulation. As of early 2026, the data from Glassnode and CryptoQuant confirms a phenomenon that is sending shockwaves through the analyst community. Exchange balances of XRP have absolutely cratered. We have officially slammed into 8-year lows. Total XRP held across all centralized exchanges has plummeted to between 1.5 and 1.7 billion tokens. XRP. Think about the magnitude of that drain. In early 2025, major powerhouses like Binance and Upbit were sitting on reserves near 4 billion tokens. Today, those reserves have been slashed by over 57%. The systematic suppression versus the OTC reality. Analysts like Jake Claver have been pounding the table on this for years. He argues, and the on-chain data supports him, that XRP has been suppressed more ruthlessly than silver during the infamous Hunt brothers squeeze of the 80s. While the retail price was held artificially low to shake out the weak-handed, massive over-the-counter OTC deals were happening in the shadows. We are talking about billions of tokens being funneled directly to sovereign wealth funds, central banks, Tier 1 institutional custodians. This isn't selling. This is a migration. Tokens are moving from the shallow pool of retail exchanges into deep cold storage and operational payment corridors. Once a token enters a multi-stake institutional vault or a central bank bridge, it doesn't come back to the market to be traded for a 10% profit. It is gone. Jake Claver calls this the programmed nature of XRP's growth. The utility-driven trajectory is backed by irrefutable on-chain evidence. When over half of the readily tradable supply vanishes from the platforms where 99% of trading occurs, you aren't just looking at a dip, you are looking at a coiled spring. When the final catalyst hits, be it total regulatory clarity or a global liquidity crisis, the buy-side pressure will hit a brick wall of no supply. As the sophisticated players lock away their billions, the retail liquidity pool is contracting at an unprecedented rate. Tab. The foundation is no longer just being built, it is being fortified. Tab. Are you watching the shaking hands in the retail market, or are you watching the iron hands of the institutions? If the exchange drain we just discussed was the smoke, the spot XRP ETFs are the fire. We are witnessing something unprecedented in financial history. As of late January 2026, the data confirms a total paradigm shift. While retail was busy debating $2 versus $241, 7 US-listed spot XRP ETFs have been operating like a giant, unrelenting vacuum cleaner. Tab, the numbers are staggering. Collectively, these funds, led by Canary Capital, Franklin Templeton, and Bitwise, now hold over 786 million XPR. In just over 50 days since the major launches in late 2025, XRP has become the second fastest crypto asset in history to cross the $1 billion AUM threshold, trailing only behind Bitcoin itself. But here is the signal that the mainstream media is ignoring. Look at the divergence in late December 2025. On days when Bitcoin and Ethereum ETFs were seeing massive outflows of hundreds of millions, XRP ETFs didn't see a single day of net redemptions. In fact, for 43 consecutive trading days, money only flowed in. This is what we call sticky capital. This isn't fast money looking for a quick trade. This is pension funds, university endowments, and wealth management giants like Franklin Templeton managing $1.6 trillion, officially normalizing XRP as a Tier 1 digital asset. Why does this matter more than retail trading? Because of the settlement mechanism. When a traditional institution buys through an ETF, the custodian like Coinbase Custody or Anchorage must go into the market and buy the physical spot XRP. They take those tokens off the exchanges and they lock them into regulated institutional-grade vaults. This is a one-way valve. These tokens are not being lent out to short sellers. They are not being used for high-leverage gambling. They are being held as long-term reserves. As Jake Claver has relentlessly hammered home, this is pure one-directional high-conviction accumulation. Every time a wealth manager clicks buy for their client, the liquid supply on Binance and Upbit, which is already at 8-year lows, shrinks even further. We are moving from an era of abundance to an era of scarcity. The ancient FUD of too much supply has been buried under a mountain of institutional capital. When the $4 trillion tokenization wave fully hits these rails later this year, the market will realize that there simply isn't enough XRP left at these prices to facilitate the volume. And as the calm analyst, I ask you, are you selling your position to the very institutions that are trying to corner the market? Or are you planning for the scarcity that is already here? Now let's stack the most explosive layer of this puzzle, the mechanism that turns XRP from a digital asset into a deflationary monster. For years, the escrow was used as a weapon by FUD merchants to claim Ripple was dumping on the market. But as we stand here in January 2026, that narrative has not only been defeated, it has been flipped. On January 1st, 2026, Ripple executed its scheduled release of 1 billion XRP. But look at what actually happened behind the curtain. As Jake Claver correctly pointed out in his recent deep dives, the vast majority of these tokens, typically 700 to 800 million, were immediately relocked into new escrow contracts, some reaching as far out as 2028 and 2029. The tiny fraction that remains is not for retail dumps. It is strategically allocated for ODL liquidity hubs powering the $15 billion in real-world flows we are seeing today. Direct institutional OTC hand-delivered to the very players we mentioned in Section 1. This is programmatic discipline at its finest. Ripple cannot emergency dump even if they wanted to. They are bound by the ledger's ironclad code. But here is where it gets truly savage for the supply side. Every single transaction on the XRP ledger, whether it's a $100 million settlement or a tiny NFT trade, permanently incinerates a micro fee. As network usage climbs, we are seeing daily burn rates that are beginning to compound. Leading on-chain forensic analysts are now projecting that if the ledger hits peak congestion from institutional tokenization, we could see the burn rate accelerate to 1 billion tokens annually. Think about that math. Fixed cap 100 billion, never more. Lost locked, billions already gone. Daily burn accelerating every second. Jake Claver has been pounding the table on utility-driven trajectory. When you combine the massive exchange drain, down to 1.5 billion tokens, with the ETF vacuum hoovering up 786 million XRP, you realize that the liquid supply is now a tiny sliver of the headline total. We are watching a perfect storm brewing in real time. One side of the equation has an insatiable hunger from $4 trillion in tokenized assets. The other side has a supply that is being locked, burned, and vacuumed away by the largest institutions on Earth. The 100 billion token cap is no longer a large number. In a world of quadrillions in derivatives and trillions in cross-border settlements, it is a tiny, finite lifeboat. As the calm analyst, I see the mechanics. I see the data. The price is the last thing to reflect the reality of the plumbing. Are you looking at the volatility of today, or are you looking at the mathematical certainty of tomorrow? Everything we have discussed so far, the exchange drain, the ETF vacuum, the escrow discipline, serves as the foundation for the single most important shift in financial history, the tokenization of everything. As we sit in late January 2026, the numbers are no longer projections, they are reality. The XRP ledger has officially moved from being a payment rail to becoming the global settlement layer for real-world assets, RWAs. Just days ago at Davos 2026, Larry Fink, the CEO of BlackRock, sent a lightning bolt through the industry. He didn't just talk about Bitcoin. He talked about moving every currency, every ETF, and every asset onto a single global settlement layer. I hate to cut off the Bitcoin. While the retail crowd was watching the price of XRP fluctuate around $2, Brad Garlinghouse revealed a figure that should make your heart race. The volume of tokenized assets on the XRP ledger has exploded from 19 trillion to over 33 trillion in a single year. This isn't trading volume. This is institutional balance sheet reality. We are seeing tokenized treasuries led by giants like Ando Finance, which just surpassed 2.5 billion in TVL. Institutional stocks moving on-chain for instant T+0 settlement. Corporate debt being issued directly on the ledger to eliminate the friction of legacy banks. But how does XRP capture this value? The answer lies in the synergy with RLUSD, Ripple's regulated stablecoin. As of January 22, 2026, Binance officially listed RLUSD, integrating it with XRP pairs. This isn't competition for XRP. It is a force multiplier. RLUSD acts as the safe harbor for institutional liquidity, while XRP acts as the universal bridge underneath. Every time a multi-billion-dollar tokenized asset moves across borders, it uses RLUSD for stability and XRP for the instant sub-penny settlement that SWIFT simply cannot match. Jake Claver and other veteran analysts are pound for pound correct when they say the current valuations are laughably undervalued. If the XRPPL captures even 5% of the global tokenization market, the demand for XRP as the gas and bridge for these trillions will collide with a supply that is at 8-year lows. We are moving into a world where XRP is no longer an alternative investment. It is the plumbing of the 21st century economy. The institutions aren't just buying XRP for a trade. They are buying it because they cannot run their future empires without it. As the calm analyst, I see the chains of the old system breaking. The question is, are you holding the keys to the new system, or are you still waiting for the perfect time to start? We have reached the point of no return. When you look at the evidence we've dismantled today, from the 8-year liquidity lows on exchanges to the $1.3 billion institutional vacuum of the ETFs, a single undeniable picture emerges. XRP is the most suppressed yet most prepared asset in financial history. The final obstacle, the lack of regulatory clarity, is being dismantled as we speak. The Digital Asset Market Clarity Act of 2026 is the final fuse. Once it is lit, the risk premium vanishes. The wait-and-see money becomes all-in money. Experts like Jay Claver aren't just looking for a price pump. They are anticipating a paradigm shift, when trillions in tokenized assets meet a supply that is physically contracting every single day through burns and institutional lockups. Today's valuations will look like a historical error. The institutions have spent years trying to shake you out so they can take your position. But data says they are succeeding with the impatient, but failing with the rational. Stay focused on the rails, not the noise. The transformation is no longer a matter of if, but when. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss, while calm analysis leads to victory. Thank you for your trust, and thank you for being part of this rational community. I am the calm analyst. Stay patient, stay rational. And as we always do, we don't wait for the future. We plan for it.